Welcome to Stock Talk with Nico Kritikos. Today we're going to do some stock analysis for Docusign, ticker DOCU. This company just reported earnings today. The stock is moving up just a little bit over 3%. If you don't know, Docusign is the leader in e-signatures. They are a $10 billion company with over 7,000 employees. Today we're going to find out what kind of position is this company in. Are they financially healthy? And what does the future look like for this stock? So right off the bat, we're going to start with revenue. They have no problems growing revenue. Revenue has grown at an average of 37% a year in the last 5 years, with them doing $2.5 billion in the last 12 months. So revenue looks strong. That's going to get a check on my list. However, as for net income, doesn't look as good because we have consistently seen negative income. Last year, it was negative $100 million, and this does not seem to be improving at all. So that will not get a check. Then we look to the PE ratio, and as you can imagine, there is no PE ratio because it's a money-losing company. So we will rely on the price to sales metric, which over the last couple of years, the price to sales is actually in a healthier spot now than it's been. Right now, it's at a price to sales of about a 4. And for a company that's been growing revenue at 35+%, that is very attractive. Now, in the trailing 12 months, the earnings they just reported today, those numbers were, the revenue was only up 11%. So things seem to be declining a little bit. That would make a little bit more sense why it's trading at a price to sales of 4. But if they can get back to a 30% revenue growth mark, that is very impressive. Are they innovative? Yes, very innovative. It's e-signatures, so that's what their business is all about. Their market share is incredibly strong. Not many companies can say they have a 70% plus market share in their industry. And this is, I looked up many different sources. It looks like it's anywhere from 55 to 77% market share globally. And so they are number one in the world of e-signatures. And then we get to their return on invested capital, which, as you can imagine, is negative. Their equity is growing. I was pretty impressed with the last 12 months of their equity. Not the last 4 years. It's not as good. But the last 12 months, we've gone from 400 million to nearly 750 million. So that number is improving. But over the last couple of years, it really hasn't moved much from 500 million to 600 million, 700 million. So not a big thing there. But the last 12 months is impressive. The equity is definitely not 15%. We're talking about a $10 billion company and only 700 million in equity. Now, the other thing I want to pull up is analyst expectations. We're looking at only 8% revenue growth and then 7%. That's not good. EPS slowly getting a little bit better. Nothing crazy. And I used to own this stock back in the Cathie Wood days. I bought this stock I started buying at 150 and I bought all the way down to about $70 a share consistently. And then after about 6 months or so of waiting, it looked like a lost hope. So I sold out at about $60 a share, $65 a share, and I took my loss on that. So, and really looking back, that was 6 months ago I did that, 7 months ago, and the stock is even down further. So that was a good move. But if we look at the stock chart, in the last 5 years, this company has had a really bad run. I mean, it's the same price it was 5 years ago. This is just a huge, this should have never happened. This big hype right here that happened because of Cathie Wood, that should have never happened. And at this time, when the stock would come down to, 150, I thought, oh, this must be a terrific deal because this stock surely is going back to $200 or $300, and they're the number one player in the space, and they are in an industry that's growing. Like e-signatures should not be going away anytime soon. So I was like, okay, this is going to be an easy investment. But as it turned out, no, the stock came back down, and really, I think it's all because of the fact that they're not making a profit. I think that's the most important thing. But if we get back to the list, the share count is definitely not decreasing. I will show you the chart right here, and they're definitely consistently adding shares. So not horrible. The last couple of years, it's only been about 2 to 4%. So not horrible, but definitely not helping. The assets are definitely not 2x the liabilities. Profit margin is negative. The cash and receivables is somewhere under $1 billion, I want to say. Either way, it's more than the net income because it's zero income. No dividend. The company is, I believe, like 20 years old. And then growing free cash flow. This is the most interesting one. So before we get to that, though, I want to review their earnings for today. So we have the company reported this for Q2 net income of $7 million. So that's not bad. At least they made a profit, because they were expecting a loss of 45 million. So really, I think the stock should be up like 15% right now. That for that big of a jump, like profitability is what is a make it or break it situation, especially for this company and where they're at. So the stock should be up 15 or 20%. I'm actually surprised it's not. Maybe it will be tomorrow, but if they were expecting negative 45 cents a share and this company is consistently unprofitable, I would think that a profitable quarter should be bigger news than how they're treating it right now. But we have that. We have 22 cents a share, but really you could say it rose to 72 cents a share, and last year it was 44 cents a share if we want to be consistent with our metrics. So overall, it's a good earnings report, and they gave good guidance as well. But I'm still, so even though the stock's up 3%, I'm actually surprised it's not up way more than that. So we'll see what happens with that. Then we go back to the chart for free cash flow. And what we're going to see here is that free cash flow is positive, right? Well, actually, let's look at this. So here's regular free cash flow. Okay. It's positive. We've seen there's a couple of years of growth here. So it looks a little bit better, right? But here is the problem. This is for the free cash flow chart alongside the stock-based compensation, which means how much money they're spending hiring people, paying them with stock, right? So 2019 was probably the worst year possible. Look how bad that year was. And then all these other years, the stock-based compensation, besides for this one, stock-based compensation is higher. So that's why they're losing hundreds of millions of dollars. And that's why that's an issue. Look at this one, for example. Free cash flow of 45 million. Stock-based compensation of 410 million. So that means any positive free cash flow they had, they spent 10 times more than that to hire new employees or whatever they did with that compensation. So that's where the problem is. So that's why we look at stock-based compensation, adjusted free cash flow, and what do you know? It's actually negative. It's not consistent, and it doesn't look good. So that's why this is so important to factor that stock-based compensation in, because that's what's hurting the company. That's what's hurting the company, and their net income is negative. So they need to get things together here. Let's look at their expenses. I'm curious to see what their expenses are. So most of it is in we have research and development, and then we have, what's S&M? Oh, sales and selling and marketing, probably. So yeah, I mean, they're spending too much on selling and marketing. So that's the problem. They need to cut costs. I mean, I guess you could say it worked, because if they have 75% market share, that's very impressive. Now they're going to have to probably cut back on that and try to get those consistent subscription-based customers to keep paying them. So I have no plans to buy this company unless they can prove they're going to be consistently profitable. But until that point, other than that, everything else looks great. I mean, once they're profitable and ROI looks good and all that, the balance sheet starts getting better, all that stuff will flip as soon as that happens. And they need to cut back on expenses and stock-based compensation. So if they made a couple of those adjustments in the next couple months, then I'd be happy to buy this stock, because I think they have an incredibly strong market share and they're in a very good industry. So that's my stance on Docusign. But until that happens, I will not be buying the stock. Thank you for watching. I will see you in the next video.